If it was dead, we wouldn't be talking about it anymore. I think about, well, let's remember during COVID when gas prices went negative for a day. Let's say you were stuck in traffic. In New York, you might be going through the Holland Tunnel and you're surrounded by these cars belching gas. You knew that gas wasn't going to stay negative forever, right? Was there an opportunity for a value investor to buy something that was being dumped at the time? Of course there was. At Ruane, my firm where I work, our average holding period was 7 years. And we've held stocks, Berkshire Hathaway, 30 years. And you're never going to get 10 baggers, let alone 100 baggers if you're buying and selling every day.
Hello everyone and welcome back to another episode of Conversations with Leaders. I'm Sam North, your host today, and I'm joined by Greg Steinmetz. Greg, it's great to have you with us. How are you?
Great. Thanks for having me, Sam.
Well, it's great to have you on. We're going to talk about a couple of the books that you've written. We'll also talk about the third, potentially, that's on its way. We'll talk about your time as an analyst in your career as well. For regular listeners, you know Matty Alon very well, so I've had the pleasure of finding out a little bit about both of you already, but we can get into that shortly as well. First up, Greg, I want to talk about your book, The Richest Man Who Ever Lived. First of all, the title really grabbed me, so it's quite an interesting story. The Life and Times of Jakob Fugger. It offers, sort of an insight into their life where a lot of people wouldn't ever have heard of this person before. What inspired you to write about it? And what lessons from his life do you think are most relevant to investors in today's world?
At the time that I had the idea, I was working as the Berlin bureau chief at the Wall Street Journal. And in Germany, Jakob Fugger is a well-known name. Doesn't quite have the same resonance as Rockefeller in the US, but it is a word that means someone who's very rich, very conniving, very savvy, very smart with money. And you see that name thrown around here and there. And Americans and people outside Germany, they didn't know about him. I asked around. No one had ever heard of him. And for someone, as a journalist, you're always looking for a book to do to prove that you're credible, that you're more than just writing up press releases. I thought, okay, here's an opportunity. And I contacted an agent out of the blue, and he immediately saw the relevance of the story. And then the publisher immediately saw the relevance, and it went from there. And the idea that he was the richest man who ever lived, that's controversial because there are others who get attributed that. But in his case, he was the richest commoner, someone who came up not being a king, not being a member of the nobility, made money on his own. And if you do a calculation where you take his worth and divide it into the prevailing European GDP, which is how you do these calculations to figure out who's the richest, he was the richest who ever lived. And in terms of his investing lessons, the one big one that I keep thinking about is, well, what can we learn as investors? We can learn to invest in companies that share some of Fugger's attributes. And the biggest one that comes to mind is being indispensable. Fugger made himself indispensable to the Pope. He made himself indispensable to Charles V, the ruler of the Habsburg Empire. And by doing so, he was able to not only extract very nice fees and profits from them, but he was also able to survive in a time when it was very difficult to survive when you had as much money and power as the emperor or some of the other people you're living to. The analogy that comes to mind, I think of that oligarch in Russia, Khodorkovsky, right? He got very rich. He thought he was bigger than Putin. He ended up being tossed into jail. Fugger always lived with that risk. If the emperor and the Pope didn't like Fugger, they could have made life very difficult for him. But because they needed him, he survived and lived to a ripe old age.
Yeah, it's a fascinating story. I recommend everyone to go listen to that book. Greg, did you find, through your career as an analyst and investing and writing, that it made you a better potential investor as well? Would you take little bits from all of these stories to bring on board for yourself?
I think what it did is give me more of a perspective, a bigger timeline,
Mm.
and I'm more aware of the long-term trends and how things can change quickly, but then they revert back. And that's the great thing about history. There is very little that we haven't already seen. The technology might change, but human nature is the same. So we have booms and busts, we have fads, we have perennials, and studying these folks, I've I've gotten a much better appreciation of that, and I think it helps me keep my calm under fire.
Yeah, yeah. In your latest book, what key themes or messages do you hope readers, particularly retail investors, for the sake of this conversation, can take away, and how can these insights be applied to modern day investing?
Well, the latest book, I'm working on one now, but the book that came out more recently about Jay Gould,
Yeah.
the robber baron. Gould used to say there are a lot of stocks on Wall Street, but the biggest stock that there isn't is the stock of patience. That investors are too flighty. Uh, they change their opinions every day. And if you just sit back and stick to your guns, you do much better. And he applied that in every aspect of his life. When he was a kid, he would stay at the chalkboard if he was called up to do a math problem. He would stay there until it was finished, even if it was after all the other kids went home. He would be involved in litigation and just keep litigating until he wore the other side out. And as an investor, he would do the same thing. He would attack a company and just keep at it until he was able to drive the price down enough so he could buy it for a song. And it's similar to the lesson from the Fugger story that patience is very important. And at Ruane, my firm where I worked, our average holding period was 7 years. And we've held stocks, Berkshire Hathaway, 30 years. And you're never going to get 10 baggers, let alone 100 baggers, if you're buying and selling every day.
Yeah. Yeah. And I think for retail investors, if they were to name 5 things that they struggle with, I'd reckon most of them in that top 5 is all going to be patience, isn't it? Is having the ability to hold a winner for a long time. And you've got to let those winners run, as you're saying there. Can you share some interesting...
Boring. It's boring not to. It's
Yeah.
more fun to, right?
Yeah.
So
No,
just waiting around, the analogy I like to use, and I think we follow this at Ruane. I don't know if you have snapping turtles where you are, but there are these turtles. They lie in the pond in the mud all day with their mouth open, hoping that a fish swims by. And when it does, they snap and grab it. And a patient value investor, I think it's like the snapping turtle.
Yeah, yeah. Greg, how would you... No, I like it. Greg, how would you deal yourself with, some of the moves we've seen in the market recently? Let's just call it the meme stock stuff like GameStop, or, a market that might explode 30-40% higher one day and then drop the other. Do you just say to yourself, that's not my realm, I'm going to leave it alone? And it just doesn't bother you? Is that the way you would look at it?
Yeah, let someone else make the money.
Yeah.
It's not investing. And it's difficult if you have clients to ignore whatever's working at the moment. When I joined Ruane Cunniff, it was the year the dot-coms were going crazy. And everyone thought the people who invested like Buffett were idiots. And we had lost our way. People wanted to fire us. And then the next year, it all went the other way, and we were named Mutual Fund of the Year. So you just have it's very fun to watch, though, right?
Yeah, from the
something
sidelines.
like Social with revenue of less than $10 million, and you can see where the train is going, but it's fun to watch in the meantime.
Yeah, no, for sure, from the sidelines. How do you balance this historical storytelling with practical financial insights in your writing, which is obviously important? Do you aim to provide actionable advice for investors, or is the focus more on that sort of historical narrative, or is it just combining the two?
Well, I don't hit readers over the head with it. Put out a list. The investing secrets of Jakob Fugger. I did that as a article that appeared. Was it Business Week somewhere? To promote the book. Said, okay, here's the 10 things about investing you can learn from Fugger. But my method as a writer is to just tell the best possible story I can. And the readers, it's not too hard from reading his story to figure out the insights on their own. So my primary objective is to entertain and inform and to get the reader to turn the page rather than being prescriptive.
Yeah, no, I like it. I like it. Let's talk about your career as an analyst then, and everything around that. Sequoia Fund, how did that come about? Tell us a little bit about the fund itself.
Well, the Sequoia Fund got its start in 1969 at about the time Warren Buffett was wrapping up his investment partnership because he was doing Berkshire Hathaway. Mm-hmm. So he had all these investors, mostly in places like Nebraska and Iowa, who needed a new home. Warren went to school with Bill Ruane, the founder of our firm. Yep. Bill was an analyst and a money manager at Kidder Peabody, along with Rick Kniff. And Buffett wrote a letter to his investors, which I actually found a couple years ago. A guy I was talking to happened to have it. He had been following Sequoia for a long time. He still had that letter from Buffett. And the first thing that Buffett wrote in his annual letter of that year, I don't know if it was 69, 70, whenever it was, I've gotten a lot of questions about what to do with what people should do with their money now that I'm leaving money management. I suggest you give it to Bill Ruane. No guarantees, but he's a smart guy. You can trust him with your wallet. And that's how Sequoia got started. And then it had 3 years of horrible returns. It was a very tough market at the time it got going. Sequoia underperformed. There were questions about whether it survived. And then it went on to become the best performing mutual fund of the next 40 years, outperforming on average by 2 points. By being patient, by doing value investing, doing all these things we're talking about. Concentration.
Yeah, I think there's a big lesson in that for all of our listeners, the importance of patience. During your time at Sequoia Fund, obviously you would have met some incredible people, and again from a perspective of starting your career out there or developing your career there, I should say, is it a valuable lesson to say never stop learning? Always feel like you can learn more from other people.
Yeah, of course. But when I hear an investor say, we learned a lot from the bad experience we just had, I think, do I want to have my money from someone who's still learning? We used to own a stock in a company called Expeditors International. And the CEO used to say, we're not doing this for the education. We know what we're doing. We're past the point of making dumb mistakes. And so when I hear people say, oh, we learned a lot from that, we'll be better next time. I think, boy, I wish I was with a person who didn't have to learn that lesson.
Yeah.
Because all these lessons, if you're a student of history, or better yet, if you have experience in the market, you've seen it all. Even the meme phenomenon. I'm sure there are things that were similar 20, 30 years ago.
Yeah, I'm sure there were.
What manifests itself differently.
Yeah, exactly. What do you consider to be your most memorable investment success and your biggest challenge on the opposite side of that during your time at Sequoia?
Oh, okay. Let's see. We owned. We bought some Costco very early on, and because we have a value discipline, after it went up, a a quarter of a point from our price, we stopped. And it went on to be a 20 bagger from that point. And that was different because when Ruane was in charge, if he liked something, he would just buy it. He didn't get too specific about the price. So for me, that was a lesson, right? If you really think a company is exceptional, don't get too crazy about that. And let's see, one of the big successes we had, a company called Fastenal, which is an industrial parts distributor. Very boring business, right? They just go around, knock on doors and say, hey, can I sell you some nuts and bolts? But they had something special in that the company ran on energy and it ran on a aggressive compensation system that really rewarded people who hustled. And that turned out to be a winning formula, a unique formula. We owned that stock for about 20 years, and it was a great investment. And I probably visited about a third of all their stores. The insight that I brought, and what my value add was at Sequoia, is as a journalist, I was very comfortable talking to strangers, approaching people cold and asking them questions. And in the days before there were expert networks, we could get a lot of unique information. We didn't cross the line. It wasn't inside information, but we could figure out how a business worked just by going to trade shows and talking to people. And now you can call up an expert network and you can find 10 people who, have their stories down. They tell you how it all works. And I was talking to people who had never been approached by an investor before. And now if I were to call up someone, they're probably involved with 5 networks and it's their 10th phone call. But in the case of Fastenal, that was one where a lot of shoe leather went into making that a successful investment and giving us the confidence to stay with it through the ups and downs of the business cycle.
Yeah, I'm not sure if this next question is an easy question to answer, but when I speak to intraday traders, a lot of them say it was easier to make money back in the day than it is now. But from an investing standpoint, would you say it was easier or harder back then when you sort of started out, or would you say the opposite? What would you think?
I think it was much easier. And I wish we had appreciated just how much of an informational edge we had with the sort of research that we did. Now you can still have a differentiated opinion and have insights that maybe others haven't arrived at, but it just takes so much more effort, I think, because not only do you have to read the 10Ks and the Qs and the conference calls, you have to read all this stuff that's available through the networks, through the streaming services, the 2-hour podcasts on different companies. All of this, it just takes a lot more to just catch up with everyone else. And before, with just a few phone calls, we would be in the lead. We used to say, okay, it takes us about 6 weeks to catch up with the sell side. And from then on, anything we learn is beyond what most people know. And I don't think that's the case anymore. It's gotten a lot harder.
Yeah. Did your writing perspectives, your approach to it, did it change much from your time as an analyst?
The way I wrote?
Yeah, and the way you went about it.
I became a better writer with each book. Only because I had done it before. As a journalist, the longest thing I would ever write might be 2,000 words, 3,000 words, and that's a lot different than 100,000 or 200,000 words. So you get better by doing it, and I'm hoping that my next book is even better than the last one, which was better than the first one.
Okay, let's talk about that third one then, just quickly. Can you give us any insights, or is it all hush hush at the moment?
No, my editor tells me, okay, your niche is doing biographies of financial folks. So give us another one, make it American, don't make it 500 years old, have some relevance to the current day and age. And I was pursuing Andrew Mellon, who was the Treasury Secretary under Harding, Coolidge, and Hoover, right before FDR. And as I got into that, I thought, okay, well, there was a biography on him. It was done with the authorization of the family. He pulled some punches. Uh, it's told more like a historian would tell it, not as someone who, didn't follow sort of a novelistic formula, which I tried to do. But then I thought, well, rather than do a cradle to grave biography, it would be more fun to just focus on the period of when he was in office. And throughout his whole career as Treasury Secretary and afterwards, when he was retired, he was in a confrontation with Franklin Roosevelt. And not only was it an ideological clash, but when Roosevelt took over, he wanted to make a scapegoat of Mellon in order to legitimize what he was trying to do, get more support for the New Deal. And he just attacked Mellon relentlessly in the courts and in the press in every way he could, and blamed Mellon for creating the Great Depression. So we have this conflict. There's opportunity in that to create some suspense, create some drama there. And it has kind of a weird ending because Mellon, at the same time, he was trying to save money by donating money to charity. The charity he was donating it to was his own philanthropic organization, which was buying European masterpieces to put in a museum that Mellon wanted to build. And that museum was the National Gallery, which he gifted to the American people. And it sits right on the Federal Triangle in Washington. And so we have this conflict here, not only between the individuals, but between the ideologies of laissez-faire versus government. We have small government versus big government. And this is the moment in American history where everything changed, where we went from being small government, low taxes, no debt, to when we have all these things in spades. And I wanted to get at what it was that created that shift. Was it just that, okay, people liked bank deposit insurance? Was it just like that they liked getting a Social Security check? Or did something change in the psyche of the American people? And I was able to get at that by exploring this story about Mellon and FDR.
Fascinating. For everyone listening or watching this, the links will be below for the two previous books. And Greg, when do you reckon we'll expect the third? Have you got a rough date?
Well, my deadline to finish it is December 25. So realistically, you probably won't appear till 27, unfortunately.
Nice. No, it's good, but it gives time for people to check out the other two, and I definitely recommend people to do that. Okay, look, a few questions now on value investing. I mean, look, some people will claim value investing is dead, especially with the rise of technology. What would you say to them?
Well, I put that question this morning to my friend Marshall Jaffe in Neuberger Berman, and he said, the fact that you're asking the question means that it's not dead.
Yeah.
Right? It's still around. If it was dead, we wouldn't be talking about it anymore. I think about, well, let's remember during COVID when gas prices went negative for a day.
Yep.
Let's say you were stuck in traffic in New York. You might be going through the Holland Tunnel. You're surrounded by these cars belching gas. You knew that gas wasn't going to stay negative forever, right? Was there an opportunity for a value investor to buy something that was being dumped at the time? Of course there was. What did Buffett pay for Apple absent the cash? 9 times for this fast growing dominant brand. No, there's all sorts of opportunities. More recently, I had an experience with a company that makes air conditioners and power supplies for data centers, a company called Vertiv, symbol VRT. It got taken over by a guy named David Cody, who was the CEO at Honeywell. Great track record at Honeywell. We built that company. It was a home run for investors. He took it over. There was a SPAC, so there was a little red flag there. But the stock was in the mid 20s. It fell down to 12 when they missed earnings. But all the work that I did told me that data centers, they're not going away. There's going to be more of them. And this guy, Cody, was the real deal. He wrote a book about himself. It was very self-serving in a way. But I knew some people who were engineers at Honeywell. I talked to them. I said, well, can you take this guy's word to the bank? They said, yeah, everything he says, if he says it, he means it. And he will move heaven and earth to make it happen. Okay, so they're making basically big air conditioners, right?
Yeah.
They're not doing anything that is in technology. That thing was just sitting there. Got down to $12. It's now over 100. Or gosh, I can look that up. Where is that? But so these opportunities come along, but it takes patience. You got to be the snapping turtle. And at Ruane, we went through years when we didn't buy anything. Well, we didn't see an opportunity. We would invest money from new investors and tell them, well, it might take 3 years before we even put all this money to work. We're not going to charge you until we do. We'd only charge you on what we invest, but we're just going to wait until prices come into our range, and otherwise, sorry. So I think maybe it's a little difficult now. All the private equity that's come in and bought up companies makes it harder. But with interest rates going the wrong way for them, maybe there's more opportunity. There'll be more things listed. So maybe it's a narrower universe, but you just gotta look around more.
Yeah, for sure. I mean, the company you're on about there, I mean, almost 9x, didn't it, in less than a year, which is incredible. A question, Greg, now on.
In fairness, I didn't see the data center thing, an AI ballooning like it did, but that was certainly nice. Yeah, it got above 100. It's now 93. Yeah.
Okay. You take that. What do you think about valuation these days when you've got all the tech sector versus the old non-tech businesses? In other words, what is a bargain in today's market from a sort of PE multiples, or do you look at it a little bit differently?
I wish that it was March. When did COVID hit? 2019?
2020.
When it was 2020, sorry. 2020. And everything was being killed, right? And here was the choice. Here was the choice we were facing. Okay, do you want to plow a bunch of money into the market knowing that it could go even lower? Or do you do nothing? And if COVID ends up killing us all, if COVID ends up killing us all, what difference does it make, right?
Yeah.
You just put in your money, and if we survive, the stocks will recover. And if the stocks don't recover, that means that COVID killed us all. So it was a very easy time to buy stocks, I think. And I think about the saying that, well, the rich people on Fifth Avenue, they stay in their mansions and wait for the bargain. Then they come out of their mansions and buy things in downturns, and then they go away for another 7 years. And that's kind of how I like to invest. You just look for that when the risk premium gets to some crazy number. Otherwise, you've got to be an item picker and find things that you think can grow at a reasonable multiple. So in general, unless there's a recession, I sort of always think the market's overvalued. But within that market, there are opportunities.
Last sort of couple of
rocks.
Last sort of couple of questions here. How do you feel about having like a cash pile, sort of waiting, patiently waiting for a real opportunity, and also, I guess, potentially understanding that you could be waiting for a fair while? Is it just is what it is? That's the way to do it, or how do you feel?
Well, the philosophy at Ruane used to be always have some cash, but that's a lot easier when the cash is earning something.
Yes,
When the cash is earning zero, and the market's going up, it can really hurt. So I guess I would want to be as close to fully invested as I could.
Yeah.
At all times.
Mm-hmm. Yeah.
But if you can earn something on the cash, that
Makes it a bit easier.
That makes it easier.
Yeah. Okay. Final question. Areas in the market for the future that you like the look of? Is there anything that sort of sticks out to you at the moment?
The things that I'm most comfortable with are those companies that I think I can understand or have a shot at understanding. So that takes me towards industrials and retail. Retail is very tough because unless you've got something special, I think Costco has something special. A company like Aldi has come to the U.S. and they're talking about thousands of stores, and I think that's realistic. Now you can't invest in them, but they have something special with a very lean SKU count. Industrials, anything in aerospace where the FDA has only approved one item for a specific plane, where you have a monopoly on those parts, those kind of businesses. But right now, I don't know. I don't even know what's cheap. And if it's a bank, I don't know if I'd want to go near it.
Yeah, for sure. Greg, it's been an absolute pleasure having you on. As I mentioned in the bio of both the podcast and the YouTube, people can find links to your socials and also the books as well. But Greg, thank you so much for coming on.
Yeah, thank you, Sam. This was a lot of fun.
Thank you.